All right, well, good evening, everyone, and thanks for joining us. Before introducing our featured speaker, Peter Winnett, I want to just tell you a little bit about what's going on, and we really appreciate your support of the Land Trust. For those that may not, or the most exciting news is that on Friday, the governor announced that NYSEG, New York State Electric and Gas, had chosen to cancel the auction of its Bell Station property. And this is the largest remaining piece of private property on a Finger Lake. It's on Cayuga Lake, 470 acres with 3,400 feet of shoreline. And we've been pursuing it for a number of years. And we're prepared to pay fair market value, but an auction situation, we are concerned that given the volatile market, we're bound by an appraisal process and other bidders might not be. So we're now entering into direct negotiations with NYSEG. And in the end, we hope that it will become most of it a new state wildlife management area with all that shoreline. And then a portion of it would be utilized for a solar project that's been endorsed by the town of Lansing, where it's located. So that is one of the bigger projects we're undertaking. And a portion of the funds needed for that will come from our internal revolving loan fund. And this is a fund that we've used on a number of occasions and has benefited directly from planned gifts. And it's just one way that contributions through planned gifts can, leverage conservation across the region. As we've been working on this project, I'm also pleased to announce that over by the Greek Peak ski area and Kennedy State Forest, adjacent to the Finger Lakes Trail, after years of effort and coordination, we synchronized 3 conservation easement donations, legal agreements that limit development while allowing it to remain in private property, and a great story of 3 adjacent neighbors who worked together to protect 250 acres that's right in the middle of this forest area. So that is a wonderful project that took place. Over in Canandaigua, we completed our 9th acquisition on Bear Hill, which is an iconic landmark on the east side of the lake. This is another partnership with the State Department of Environmental Conservation. So that's land that ultimately we'll put in their hands. And then coming up this Friday, we'll dedicate on the west side of the lake a brand new preserve. If you're free on Friday at 2 o'clock, we're going to cut a ribbon on a very scenic preserve in the town of Canandaigua, just north of the Bristol Harbor, where the resort was. And that'll be a ribbon cutting followed by a hike on our latest nature preserve. And coming up, hopefully it might even happen before then, here in the Ithaca area, we're about to close on a very popular access point to the Finger Lakes Trail that is borders State Route 13 right next to Robert Treman State Park. And it's one of the most popular stretches of the Finger Lakes Trail, but it's a field that was zoned for industrial use. So again, thanks to your support, we had the resources needed. When that came on the market, we could jump on it and it'll be conserved and remain accessible to the public. So all of these projects benefit from charitable giving and particularly planned gifts. Before I turn over to Pete Winnett, who will be your primary presenter, I just want to mention one charitable gift, a planned gift we got last year, where Cliff DeMeo was a longtime school teacher in the Ithaca school system, longtime supporter of the Land Trust, and he left us his home through his estate, which we then were able to resell and use those resources for conservation. So that's just one example of how planned gifts are having a real impact in our work. After Pete's presentation, there will be time for question and answer. I'll look to him for guidance on a lot of this, but if there are land-specific questions, I'm happy to share what I know. But turning it over to Pete, I want to mention that he has been with John G. Ullman and Associates since 1997. He has a broad range of expertise, including estate planning, retirement planning, tax planning, just to name a few. Outside of work, I was intrigued, not only is he a longtime distance runner, but what I was intrigued with is on his bio, it notes that he is a high performance driving participant. So Pete, I really appreciate your willingness to share your knowledge here tonight. and look forward to hearing your remarks.
Well, Andrew, thanks. Hello, everyone. Listening to Andrew and hearing everything that's going on with Finger Lakes Land Trust makes me realize why I was more than happy to give a little bit of time to do this. As he mentioned, I've been doing this a long time. And when I'm talking to clients of the firm, they don't know what they don't know. And this is one of the areas where I think we make a difference for people, because there are smart ways of giving. None of us give of our time, talent, or treasures to organizations for tax breaks. We do it because we want to help. And maybe I can give you a couple of ideas of a way to use your treasure to help efficiently. So we'll touch on some of those things. I don't like to talk a lot. I'd rather kind of get through some slides that we have, and then leave plenty of time to answer specific questions at the end. And as Andrew mentioned, if it's related to conservation easements, giving of land, he's much more knowledgeable on that. So I'm going to defer to him on those questions. Okay. And so I have a disclaimer, which I will read. The information discussed in this presentation is current as of the date noted and is for informational purposes only. It does not intend to address financial objectives, situations, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any program or service is dependent upon the individual's circumstances. The products and/or service descriptions, if any, provided in this webinar are not intended to constitute offers to sell or solicitations in connection with any product or service. I might add to that this idea that these are for illustrations. Probably the most frequent answer I give my clients when they ask a question is, it depends. And that's going to be the case with many of you. So tonight I'm going to touch on just a few areas which I think will have widespread interest. I'm going to talk a bit about gifting appreciated stocks, donor advised funds, qualified charitable distributions, and I'm going to add another one, which is naming the land trust as a beneficiary on your IRA. I think these are ones that you might find interesting and be helpful. I just have to get to the point where I can advance correctly. Now, the gifting of appreciated stocks is something that we've done for a long time. And for some people, it seems cumbersome, but it really isn't. And I want to explain to you why I think that's a good strategy if you're fortunate enough to have appreciated stocks. So if you have appreciated stocks, and let's say you wanted to make a gift to any organization, and you decide, well, I'm going to sell that stock to fulfill that gift intention, you sell the stock and you pay capital gains tax on that appreciated stock. Now, if you're itemizing deductions, you'll still get a deduction for the market value of that gift, but you will have paid capital gains tax. So I want to stress here that when you directly gift stock to an organization, that on the date you give the gift, the market value of the stock on that date is the potential tax deduction that you're going to get for that gift. Now, regardless, you're going to save on the capital gains tax on that appreciated stock. You may or may not possibly get the benefit of that deduction, depending on whether or not you're itemizing your deductions or not. So by avoiding that capital gains tax, I like to look at it as an opportunity to basically be able to give a little bit more, because you don't have to give money for tax. So I've got an example here. And in this example, this person owns 20 shares of Netflix that they purchased at about $181 a share. And it is now worth $592 a share. Nice investment, don't you think? So if they have a capital gains tax rate of 15%, and that's common, it's not the only capital gains tax rate, and you add in New York State income tax on the capital gain, and state tax on capital gains is the same as your ordinary tax rate, we came up with you'd have a 20.9% tax rate on the capital gain. And on that gain, which is shown on the screen, of $8,211, you'd pay $1,716 of capital gains tax if you had sold that Netflix stock to fulfill your intent to make a gift. So if this person wanted to make a gift of about $10,000, they'd sell the 20 shares, they'd pay capital gains tax, they'd be able to give $10,131. So now, instead of paying, that cash that came from the sale of that stock, if instead you gave the stock directly to the charity, and you do that by an electronic transfer from your brokerage account to theirs, then you, in essence, aren't going to be selling that stock. So you have no capital gains tax on that sale. Now, in theory, the Finger Lakes Land Trust or the other organization would be selling that stock, but of course, these organizations are at what tax bracket? 0. So they don't pay the capital gains tax. So you now are able to still give the same amount of gift, and you've avoided that capital gains tax. And if you are able to itemize, you're going to get the value for the full amount of those 20 shares of stock, not the cash that was left over after you had paid capital gains tax. So that is a very simple thing you can do that allows you to save on taxes and potentially give the organizations you're gifting to more money than they would have gotten otherwise. It seems like a win-win. The next thing I want to introduce you to is something that has more recently become very popular. And these are donor advised funds. And you are the donor and the advisor when you open one of these funds. And there's various ways to open those. The local community foundations do them. Places like Charles Schwab and Company have low-cost donor-advised funds. And what you do is you take either cash or appreciated securities that we just illustrated, and you give those to the donor-advised fund. So suppose you gave that stock to a donor-advised fund earlier today. Your gift to the donor-advised fund is a 2021 gift. You're going to get a tax deduction for the amount of that contribution when you do your 2021 tax return. Now, this is where this gets interesting. But we have a lot of clients now do, if they're not itemizing deductions, because with the current standard deduction, a lot of people just aren't reaching that. What they'll do is in a given tax year, they will make a fairly large amount to a donor advised fund. They will then, because they've made a large charitable contribution, they will all of a sudden be able to itemize and get some benefit for the amount of that charitable gift. That money now is sitting in the donor advised fund, and it's growing, hopefully, earning interest or having capital appreciation tax-free because they no longer own it. They've completed the gift. And as the advisor on the donor advised fund, they're able to pass that money out to the organizations when they want to. They don't have to do it in the same year that they give the gift. So we have a lot of people now that will open a donor advisor fund, throw a bunch of money in it. They'll take care of all of their charities for the next 2, 3, 4 years, and then they'll do it again. And it's worked out very nicely for people. Now, the next one I want to touch on, and again, I'm going to be encouraging you to come back to these for more specifics as you want them, is qualified charitable distributions. So under the current tax law, once you reach 72 in that year, you have to begin making the required distributions from your IRAs. And those distributions are taxable, except if you give some or all of that distribution to a charity. If you do that, the portion you give is not taxed to you. It never hits your tax return. So if somebody has a $30,000 mandatory distribution from their IRA, and let's say they gave $10,000 to the Finger Lakes Land Trust, they're only going to pay tax on the $20,000. The limit on this is that you're limited per year to $100,000. That doesn't affect too many people if you compare it to the required minimum distribution, but you can give more than the required minimum distribution. And we've had a couple of cases where people have done that. I wanted to point out here too that even though the law changed and said that it used to be you had to start the required distributions at age 70 and a half, that now you can wait until the year you turn 72. The qualified charitable distribution availability remains at age 70 and a half. Possibly that was just a legislative oversight. I don't know. Maybe they'll correct it someday, but that's the way it is today. Now, this has also been useful for people doing these qualified charitable distributions. Have been useful in a few cases where someone is subject to IRMA. Is anybody out there dealt with IRMA? What it is it's additional Medicaid premium. That's what they call it. It doesn't change the Medicare that you get. It's the same Medicare. The premium is really just a tax. And the way it is set up is the amount of your Medicare premiums is a factor of your income. and it's in a stepladder function. We literally years ago had somebody who was about $100 into the next IRMA premium bracket, $100 of annual income, and a married couple. And for the year that tax return was being used to determine their Medicare premiums, they each paid about $80 more per month for the entire year. Had they given away about $100, they would have saved those extra premiums. It's just crazy how that works. But with tax planning, you possibly can make a gift so that you keep your taxable income low enough to keep yourself in a lower IRMA bracket. Kind of complicated, but I wanted to create the awareness that if you're teetering in those brackets on IRMA, using the qualified charitable distributions of an IRA will help. If you do a flat out gift of cash, it doesn't help because that's an itemized deduction. When you do it from your IRA, from your mandatory distributions, that income never hits your tax return. It's never part of the adjusted gross income. So it has a definite impact. And you end up possibly with your supplemental Medicare policy and your drug policy having lower premiums. When you do a charitable distribution from your IRA, please understand it's got to go directly to the charity. You can't take the money out and then write a check from that money. And all of the firms now, the banks, the brokers, everybody, on their IRA distribution form, they have a spot on there to designate the charity or charities where you want that money to be directed to. And most places will give you a choice. They'll send it directly to the charity for you, or they'll send it to you, made out to the charity, so you can put your note with it or your pledge card or whatever you want to do. And these apply to IRAs, not to 401ks. It's just why I can't explain that, but if there's a mandatory distribution on a 401k, you can't do a QCD. You'd have to roll over that 401k to an IRA, and then QCDs would be available to you. So all the ones I just talked about are some things that people do during their lifetimes to kind of get an immediate tax benefit. The other area I was inclined to really bring to your attention is naming charities, and hopefully the Finger Lakes Land Trust, as a beneficiary on your IRAs. It is a mistake I have seen way too many times, and I'll give you my illustration. When I first started doing this, there was a woman out in Western Pennsylvania. She was never married, and she had no children. And she named as the beneficiary of her IRA, I kid you not, her 13 nieces and nephews. And the rest of her estate went to the library where she had worked most of her life. It was a completely backwards situation, because those nieces and nephews, when they inherited that IRA, anytime they took money out of it, they were going to have to pay tax on it. If that money had been given to the library wasn't going to pay tax. And if instead she had given the money that she had outside the IRA to her nieces and nephews, there wouldn't have been any tax due on that because it's not taxable. It's not an IRA. So be aware if you have a charitable intent and you have a choice between retirement accounts and non-taxable accounts, give the IRAs to the charities. It's just a better choice. And believe me, I don't think there's a year that goes by that I don't run into situations like this. It's a simple fix. When you name beneficiaries on an IRA, it doesn't have to be all or nothing. You don't have to give it all to the charity. You can name a percentage, a dollar amount, you can customize it. So please be aware of that. There's a couple of other things I want to mention before we give you an opportunity to ask some questions. In 2020 and 2021, under the CARES Act, the Coronavirus Act, each of us get $300 as an above line deduction for any cash charitable gift. So even if you're not itemizing, keep in mind it's $300 per person for 2021. Actually, last year it was $300 in total, even for married filing jointly coupled, but this year it's $300 per taxpayer. So don't forget to take advantage of that. And although I don't think I've ever seen this be a factor, in most years, the amount of your cash gifts is limited to 60% of your adjusted gross income. So if somebody had adjusted gross income of $50,000, they can give away 30,000 of that as a maximum. Under the CARES Act, that 60% limit is eliminated for 2 years. So you can give away all of your adjusted gross income. So I've thrown a bunch out there, probably in a hurry, but I want to give plenty of time for you to ask the specific questions, and I don't want to be dwelling on things that are of no interest to somebody or to anybody. So fire away. Let's make this a conversation.
One comment I would make about appreciated stocks, which the Finger Lakes Land Trust, accepts and really appreciates, is that we love when people let us know they're making gifts of appreciated stock or gifts of stock. Oftentimes we get them through our broker, who gets them through, somebody else's broker, and it's hard for us to trace where the gift came from. And so for our organization and probably for other nonprofits, if you're going to make a gift of appreciated stock, it's so helpful if you reach out to the organization that you're gifting the stock to, just to make sure that they know.
And Kelly, that's a great point. We just a year or two ago, because we were having so many problems with the organizations not knowing where the stuff was coming from, we've started to send out letters to the organizations. Now, if you're working with, a brokerage house or something, they're probably not going to do that. So you need to do it yourself. But it's a common problem. Thank you for bringing it up.
Pete, have you seen more individuals utilizing gifting IRAs, particularly because the new rules for individuals that inherit IRAs that have to pay it down faster? Is that becoming more popular?
I think it will be. I mean, so what William is referring to is a beneficiary of an IRA, other than a spouse, and the rules are different for spouses. They could stretch out the IRA distributions over their life expectancy based on IRS tables. Well, the new rule that the legislature passed is that you now, if you're non-spouse and you inherit an IRA, all of it has to be paid out within 10 years, not each of the 10 years, but within 10 years. So this idea of stretching those payments out for children or grandchildren or others over many years is not going to work the same way anymore. So it makes giving IRAs to charities, or a portion of them, even more attractive than it was before. I would be curious if anyone could volunteer if you have been using the qualified charitable distributions.
I know that we receive them, and so I know many of our donors do use them.
They're really incredibly simple to use. With one of the products that I like for those, probably the best, is by Charles Schwab and Company. And the reason I like it is, and I don't understand how they do this, but I think they allow you to make gifts as small as $25. Administratively, it would seem like a nightmare, because you could fill out these requests for hundreds, I suppose, or at least dozens of small gifts from your donor advised fund. But they really are very effective tools. And this idea of making a large gift now and funding your future charitable intent does allow some people to get an immediate tax deduction for that, and yet control the timing of when they get that money out. So for people that are 70 and a half or older, it's been a big help.
The one thing I would like to just mention on the land side of things, if you are interested in considering leaving land in your will, whether to the Finger Lakes Land Trust or any charity, I really advise reaching out to that charity to make sure that they're on the same page with your intentions for the land. Because not so much here, but in my past experience in conservation, there have been some thuds when someone had very specific intentions, but never let the charity know. And then when they had passed, the charity was not able to honor that. So we really appreciate it, whether it's a property that is agreed that we're going to seek to conserve it, or an asset property of understanding the moving parts of a possible receiving a house. So in general, I think land trusts are well suited to deal with property because that's our daily business. But it's important, if you are considering any kind of provision in your will, just to consult with that charity.
Pete, I may have misunderstood what you were just saying. Are you saying that, and I'm not old enough to do this yet, so it's sort of a moot point at the moment, but with a qualified charitable distribution, you can make those to a foundation or a donor advised fund? Or
No.
they have to, I thought they had to go directly to it.
They cannot go to a donor advised fund or a private foundation.
Okay.
Pete, I have a question. So you spoke a lot about naming charities such as the Land Trust as a beneficiary of one's retirement plans.
Yes.
Are there other examples or avenues to name charities as a beneficiary of, such as life insurance policies? And I'm wondering if you have any experience in that area and if you could speak to it a bit.
Sure. Absolutely, life insurance policies can be left to charities. And just like the IRAs, you don't, it doesn't have to be an all or nothing. You can carve out pieces. So it's not a bad thing to do, but you always want to look at all the options that are available to you. So as just an illustration, if you had a 401k, let's say, and a life insurance policy, you'd still be better off giving the charity the 401k, because the 401k would be taxable to individuals. The life insurance proceeds are not taxable to the individual. So they're going to be better off with life insurance proceeds. That's why when you have goals, objectives, it's really good to get connected with someone who knows these strategies and knows the tax rules, so you get the optimal outcome. For those of us that do this all the time, this is pretty easy to look at and figure out optimal strategies. So never be afraid to ask.
I have a question about the AGI limits. Is that for the qualified charitable donation from your IRA?
Well, the IRA one is the maximum you can do in any given year on that is $100,000. The AGI limits are for any cash gifts that you would give. So it used to be, I mean, the way it usually works is when you have a gift on your Schedule A, your itemized deductions, that's limited, those gifts, to 60% of your AGI. For 2020 and 2021, that limit has disappeared. I'm sure it'll be back in 2022.
Is everybody satisfied with no lingering questions for tonight?
I was going to ask Pete one more question. Sorry.
Oh, no, go
can you-
ahead.
Can you explain the approach of lumping your gifts as a tax strategy, lumping it every other year to optimize your tax brackets?
Sure. Lumping is a term that we use around here. I don't know if it's used elsewhere, but it's kind of what I talked about before. If you're not able to itemize, or you usually don't itemize, you would take and you would make this one big gift in a given tax year. And we've had people do this. I've had people do like, 50,000 or 80,000 at a time. It throws them into being able to itemize all of a sudden for that 1 year. But so it takes them from not getting any benefit of their annual gifts, getting a one-time benefit for a major portion of that gift. Now it's sitting in the donor advised fund, and then you can give it out. So one couple I work with, they typically do about 40,000 at a time. They give money to their church, WSKG. There's a bunch that they support, ones that they're passionate about. And then when that gets low, they'll do it again. So the way it's been working out is about every 3 years, they're getting a tax benefit for their gifts. And if they were making that equally, they wouldn't be getting any benefit. That's what we call lumping. So you make lump contributions. You could do that. You don't have to do that to a donor advised fund. You could do it directly to the charity. So if you were typically giving $10,000 a year to the Finger Lakes Land Trust and you weren't getting any benefit for that gift, I'm sure that they would accept $30,000 this year for the ideal that they'd have to wait another 3 years to get the next gift. Takes me back to Wimpy. I'll gladly pay you for 2 hamburgers, for 2 hamburgers today, tomorrow, I'll pay you for 2 hamburgers tomorrow for 1 hamburger today. Anybody remember that? So it's not, that's not a bad strategy, and it's usually got a partial benefit. It doesn't mean you're going to get a deduction for every single dollar.
What happens to the money in a donor advised fund if you die?
Well, you typically would name successor advisors, so that could be a family member. And I'm glad you brought that up, because I actually encourage the families I work with, the people I work with, I love it when they name up front family members as additional advisors. If you can get your children, your grandchildren in this ideal of kind of thinking about and managing their philanthropy, it's a home run, because it builds rapport in the family. It gives you something to rally around. So it's fun. And most of the clients, I'm not going to say it's on all of them, but most of them have found it to be something the family really, really appreciates.
That kind of parties with, we've been redoing our financial things with our advisors, and they've made different suggestions, but one of them was to write something called an ethical will to children and grandchildren in terms of what our values are and what we might want them to do with their money or lives and things like that. So that kind of goes right along with that.
Yeah, it would. It would. And my experience with the donor advised funds is, as long as you're giving to a qualified charity, the organization that you've given funds to, so I used as an example Schwab, but it could be a community foundation or whatever, they typically will do whatever you want. Now, the community foundation of, I don't know, I think it's now the Elmira Corning and Southern Finger Lakes Community Foundation, they generally would like to see about 50% of that money stay in the region. So you do have to be careful of which donor advised fund you open up. Because if what you're really interested in is supporting your university or college, and that isn't in the region, that might not fit with their mission. So you got to make sure your missions align with their missions.
So Pete, we have a question. How do you feel about having your assets work through a trust? Would it work the same, through, the trustee, whoever's going to be executing that trust when it's executable, or what are your thoughts on that element?
So the trust you're referring to, are you talking about a revocable living trust or a testamentary trust?
A revocable living trust.
Okay. So a revocable living trust is really a surrogate for a will. So you can, just like you can in a will, you can stipulate where you want monies to go to. So they'll work, but you got to keep in mind, as an example, we had talked quite a bit about naming charities as the beneficiaries on IRAs, or as Kat brought up, on an insurance policy. Those aren't covered by your living trust. They're not covered by your will. They're covered by the beneficiary designation. It's frustrating to me because I see attorneys do these beautiful living trust documents, and they don't really think about the assets that aren't going to pass through that living trust because they're not titled to the living trust. So I guess my caution there is just be careful that you know how it's going to play out in practice. You can certainly use the living trust. You can name charities in there. It's just a different way of doing the same thing. I don't have a problem with it, but I don't see any particular advantage to it either.
Okay, so it really sounds like, in setting it up or looking at your assets and, annual reviews and everything, just making sure that the distribution that we intend is somehow documented either through the beneficiary, let's say in an IRA, or through the trust, right?
Right.
Okay, thank you.
Yeah. You're asking some good questions, and I'm never quite sure how to say this and get people to understand that I'm sincere, but I will not mind at all with follow-up emails or phone calls. I do this because, I believe in the Finger Lakes Land Trust, and you guys do too. And I have this knowledge, and I'm just willing to share it. So when you call me, there's no expectations. I'm not all of a sudden going to be trying to chase you down to become a client. I'm personally at a point in my life where I don't need to do that. The firm certainly likes to get introduced to people, and it's a chance for you to get to know us. But if you want to call with specific questions about your circumstances, I'll give you my opinion. And I'll continue to do that this evening for any more questions that you may have.
Thanks so much, Pete. All right, anybody else?
Well, at this point, if there aren't any further questions, Pete, I would like to thank you so much for sharing your time and expertise, and all of you for your interest and your support of the Land Trust. So again, don't be shy. If you have follow-up questions for Pete, he is available. And Pete, again, thanks so much. We really appreciate it, and thanks everyone.
Well, I'm glad to have done it. And as I said earlier, the commonality here is it's not about all of these techniques and the tax savings. It's if you're going to support an organization, and hopefully the Finger Lakes Land Trust, do it in the most efficient way you can. You can financially benefit. They can financially benefit. So, don't be wasteful and get the best outcomes you can. And thank you all for giving of your time this evening to be part of the discussion.